Hello everyone, thank you for attending this course. Today we will continue our journey of investigating socially responsible investing strategies and introduce a second strategy, ESG integration. ESG integration has been gaining momentum because becoming the most widely used strategy by SRI investors. And let's move on to the agenda. Here we divided this course into two parts. I will start with briefing the short history of ESG investing and defining ESG integration. And then I will move on to analyze two quantitative papers dedicated to this topic and published in highly ranked journals. And the first paper, written by Lars Kaiser, utilizes ESG risk materiality concept to show the European investors can achieve higher level of ESG performance without destroying portfolio risk-adjusted performance. And the second paper, written by Emil von Duren and colleagues, they designed a survey to unveil the divergent preferences of asset managers on various ESG factors. So ESG investing as a further extension of sustainable investing emerged in the early 2000s and aims at gaining influence or having an impact on sustainable issues that investors care about. At 2004, the Global Compact, launched by Annan, the UN Secretary General, produced the landmark report Who Cares Wins, providing recommendations on how to incorporate ESG issues into analysis, asset management, and security brokerage. When the time comes to the late 2000s, several initiatives and organizations were founded to advocate ESG practices. For instance, the United Nations Principle for Responsible Investment and the Global Impact Investing Network. Over early 2010s, new agreements and standards were established to further regulate the booming ESG trends. And for instance, the Sustainability Accounting Standard Boards dedicates to forming industry-specific standards for ESG disclosure, and the Paris Agreement was formed to combat climate change. Nowadays, in response to the growing consumer awareness concerning ESG issues and the strong advocate from the United Nations, and the increasing amount of companies and investment funds starts to include ESG criteria into their daily business and investment decisions. ESG integration turns from a passive reaction to an active engagement. According to the European Sustainable Investing Forum, ESG integration means that asset managers include ESG factors into traditional financial analysis explicitly, and true ESG integration requires asset managers to include ESG factors into valuation models and to establish a link between ESG performance and its valuation. There are several common pitfalls when companies try to implement ESG integration, including first, using ratings as exclusion criteria instead of valuation materials. Second, failing to materialize ESG data into investment cases. And third, lack of top management commitments. The CFA Institute, in their guidance and case studies for ESG integration, equity and fixed income report, synthesizes a best practice framework for ESG integration that advocates three phases of integration, including research, security, analysis, and investment decision. In terms of research, practitioners first gather financial and ESG information from multiple sources, including but not limited to company report and third-party investment research. And then they analyze relevant financial and ESG information to identify material financial and ESG factors affecting the target company. And finally, they discuss material traditional financial factors and ESG factors with companies and monitor the outcome of engagement or voting activities. The second component is security and portfolio analysis, where practitioners assess the impact of material, financial, and ESG factors on the corporate and investment performance. And this can lead to adjustments to their valuation model variables, valuation multiples, forecasted financial ratios, internal credit assessment, and portfolio weights. And finally, investment decisions such as increase, maintain, or decrease weightings of certain securities in the portfolio will be made based on the material traditional financial factors and ESG factors identified and assessed in previous research and analysis. And materiality is one of the most important components in ESG integration. According to International Financial Reporting Standard, information is material. If omitting, misstating, or obscuring it could reasonably be expected to influence decisions. So, in other words, material information is information that is decision making relevant. SASB's materiality map identifies likely material sustainability issues on an industry by industry basis. For instance, in the iron and steel producer industry, material ESG factors are concentrated in environmental pillar, which is caused by its high pollution and energy consumption nature. And 80% of information are immaterial and have no performance impact. Empirical evidence shows that dedicating resources on resolving material sustainability issues generates higher alpha. There are four mainstream ESG integration techniques that practitioners commonly apply, namely the fundamental strategies, quantitative strategies, smart beta strategies, and passive strategies. So when using fundamental strategies, investors usually adjust forecasted financials, for instance, revenue, operating cost, asset book value, and capital expenditure, or company valuation models, for instance, dividend discount model, and for the expected impact of ESG factors. And quantitative strategies means that quant managers construct models that integrate ESG factors alongside factors such as value, size, momentum, and liquidity. Similar to traditional smart beta strategies, asset managers use ESG factors and scores, replacing fundamental factors as weights in portfolio construction to reduce downside risk or enhance portfolio's ESG risk profile. And finally, passive and enhanced passive strategy means that ESG risk profile or exposure can be reduced by adjusting index constitutes weights or by tracking an index that already does so. The pressure from ESG integration advocates fosters a positive circle in ESG performance improvement. The loop starts from investors conducting ESG integration, utilizing the aforementioned techniques, especially focusing on including material ESG information into valuation models and creating deviation from the market benchmark. Then, based on the valuation results, investors exert pressure on target companies by over or underweighting their positions in the portfolio. And now, on the one hand, investors will realize that they can improve from valuation accuracy and portfolio performance by considering material ESG information. And on the other hand, companies will change if the cost of improvement is lower than the expected gain from the market. According to Figure 1, as of 2020, ESG integration representing over 4,000 billion assets under management is the third most popular sustainable investing strategy in Europe. An active screening remains the top choice of European investors. However, in the United States, ESG integration gained momentum and becomes the dominating sustainable investing strategies. And also globally, ESG integration has the highest assets under management compared to other six strategies. And from 2016 to 2020, the total assets under management grew by 140%, which outpaced most of the strategies besides sustainability themed investing. So the second part of this lecture consists of a detailed analysis of two research papers. The first paper, named the ESG Integration, Value, Growth, and Momentum, is written by Lars Kaiser, who developed the systematic approach to integrating ESG criteria into portfolio construction. This paper serves as a practical example of ESG integration techniques. So first, a short summary of the paper to harvest for potential of value-enhancing ESG factors. A detailed understanding of how to integrate ESG criteria into the investment process is needed. The author accounts for firm size, industry, and country effects within ESG scores, and uses the concept of ESG risk materiality to show that US and European investors can raise their portfolio's ESG level and increase risk-adjusted performance at the same time. We start with a sample selection and data processing method. So the sample used in this paper comprises all European and US firms included in the Thomson Reuters Assets for database between January 2012 to December 2015. As suggested in the paper title, the author discusses ESG integration within the framework of value, growth, and momentum strategies. And we will discuss in detail how the four factors are constructed. First, the author applies the Morningstar style box method as a transparent and easy to replicate multivariate approach to separate value stocks from growth stocks. And building on this methodology, the following 5 value score components have been considered. And they are price divided by the earnings, price divided by book value, price divided by sales, price divided by cash flows, and finally the dividend yield. And for the growth score, the author selected long-term projected earning growth, historical earning growth, sales growth, cash flow growth, and book value growth. These 5 growth factors. And finally, for each value and growth component, the author calculates percentile scores and takes the average score across all category components to determine the equal weighted value and growth rating of each firm in each year. And next, the author deducts the growth from the value score and sorts stocks from small to large. Stocks with negative style score are classified as value stocks, and those with a positive score as growth stocks. Momentum measure is rather easy. The past 12 months cumulative raw return on stock and skipping the most recent month's return has been selected as a classic momentum representation. And in terms of ESG measures, the author built on aggregated ESG ratings according to 3 pillars: environmental, social, and corporate governance. Aggregated ratings are derived from a subset of 15 key indicators. The following table represents a categorization of key indicators towards those 3 pillars. These substantive ESG ratings provided by SS4 take values between 0 and 100 by construction and are very easy to compare. However, the levels of ESG rating are most likely heterogeneous across industries, countries, and different time frame. Consequently, investment managers have to account for this implicit industry, country, and time period tilts when integrating ESG information in their investment decision making. So basically, to test these relations The author runs industry year and country fixed effect panel regression on ESG rating and firm size, and the results show that size, industry, and country play important roles in determining ESG ratings. To counter these effects, the author adjusts ESG rating by dividing a firm's annual rating by the mean rating of all firms in the corresponding industry or country groups, and as well as dividing the average rating of the corresponding firm by the size decile. And this represents an easy to replicate and transparent method to adjust ESG rating for the benefits of systematic portfolio integration. And finally, as aforementioned, materiality in this context refers to ESG criteria that have an impact on a firm's financial performance. And the author focuses on the risk perspective of financial performance. And he estimates idiosyncratic risk for each firm in year T by calculating the annualized standard deviation of the daily residuals derived from the Pharma French three-factor model. Subsequently, the author runs the following fixed effect panel regression on all firm I of industry K in order to identify industry-specific ESG risk materiality. And risk material ESG factors are defined by a statistically significant negative coefficient thereon indicating favorable characteristic as to reducing future firm-specific risk. And the graph shows the newly generated ESG risk materiality map. And this map has a quite similar material indicator allocation as the SASB materiality map. You can check it later, and which to some extent verify the author's methodology. So after cleaning and adjusting all variables, the main methodology of the rest of the paper is portfolio sorting. And the sorting criteria is a combined style or momentum ranking with the corresponding ESG ranking. The following equation shows the 50-50 weights between the two variables. And every year in June, the author rebalances portfolios based on a lagged 6 months accounting price and ESG data to ensure data availability to investors at the time of revising the portfolio composition. This is to avoid the look-ahead bias. Finally, the results. The table on slide 20 manifests main results of this paper. For example, in panel A1, all the Sharpe ratios of ESG integrated portfolios are higher than that of the basic value factor-based portfolio. And this evidence shows that ESG integration improves the risk-adjusted return of American value portfolio. And please check the table in detail and discover some other interesting facts. And in a nutshell, the author makes the following three central observations. First, ESG integration reduces portfolio risk across the full spectrum of markets and investment style. And then ESG integration results in higher risk-adjusted return for all specifications except for European momentum investors. And investors can starkly increase their portfolio aggregated ESG rating, and for the US sample by 25 to 60%, and for European sample by 15 to 30%, and depending on the investment style without sacrificing risk-adjusted performance. So this result you should be able to observe from the tables in the original paper. And then the conclusion. So overall, the inclusion of ESG information does not inevitably result in a performance drag. After adjusting ESG rating for size and industry or country effects, portfolio demonstrate higher ESG rating and improve the risk-adjusted return characteristics. And there are also some more specific findings. So, for instance, ESG integration reduces risk, And second, on average, higher ESG rating performs with value characteristic, whereas growth and momentum shows on average low ESG rating. And finally, US value investors can benefit most from integrating ESG information, both in terms of decreasing risk and realizing return potentials. Finally, we have the second paper. The second paper named ESG Integration and the Investment Management Process, Fundamental Investing Reinvented, is written by Emin von Duran and colleagues who utilized an international survey among fund managers to investigate how conventional asset managers integrate ESG factors into their investment process. So the motivation for writing this paper derives from the fact that in the field of SRI study, too much attention is paid to financial performance, whereas most research seems to be required on conceptual and theoretical ground. Thus, this paper investigates how conventional asset manager accounts for environmental, social, and governance factors in their investment process. As usual, we start with the data collection part. The author cooperated with TKP Investments, a leading Dutch fiduciary pension fund manager, and used their list of future prospective portfolio managers as the respondent source. The questionnaire was sent to 251 funds manager. Initially, 83 funds filled out the questionnaire. After a follow-up email, this number increased to 126 in total, resulting in a response rate of 50%. According to the descriptive statistics, the average self-reported ESG score is 2.32. ESG score is measured on a 4-point scale, where 1 representing respondents with no ESG integration, and 4 represents the highest level of ESG integration. Therefore, 2.32 represents the moderate average self-assessment. And meanwhile, the average fund manager manages 3 billion euro in assets and have been established for more than 14 years. And we can conclude that the respondents of this survey are experienced fund managers, which enhances the validity of this research. And finally, there is also other important information can be drawn from the table. Please try to summarize by yourself and compare them with descriptions in the paper. In terms of survey design, the author follows a rule from general to specific. They first ask for a description of the portfolio manager's investment process in general. And the first question is, do ESG play a role in your investment process? So through answering this question, the respondents gave us an overview of their self-assessments of the level of ESG integration. This has been discussed in the descriptive statistics. In the next step, the authors ask whether and how they integrate ESG in their processes. This encourages the respondents to think about the relevance of ESG in the investment process and how fund managers make use of several ESG integration techniques. And finally, furthermore, with the idea of what gets measured and get managed, attention is paid to ESG data. So system and stuff that the fund has at its disposal. And the more data available, the more likely it is the data are used in buy and sell decision regarding stocks. And finally, the author used questions that ask for specific examples that include the environmental, social, and governance issues have affected to the positioning of stock. If ESG factors are really considered important by financial managers, then it is likely that in a given year at least some stocks have been bought and sold due to ESG related reasons. Now we will have a look at the survey results. So in terms of what is important in ESG investing, the authors found one positive monotonic pattern, which is that self-reported ESG score increases with participation in UNPRI signatory. And adhering to the UN principles does improve investors' ESG wellness. When it comes to the impact on performance, most respondents expect a positive impact either in the short run or in the long run. The higher the level is integration, the more positive the respondent is on the impact of ESG investing on performance. In terms of the use of ESG information, the survey shows that respondents on average favor ratings and analysis as a company level over raw data. It suggests that the managers are constrained in their resources. In addition, investors focus on the analysis at the company level rather than at a more aggregated level like sector or country level. For most information categories, the authors observes that the need for information increases with the level of ESG integration. And these observations lend strong support to the conclusion that ESG integration is much like traditional active management based on fundamental investing, in the sense that it is characterized by a strong need for company-specific information. And then ESG strategy can have a profoundly different focus on its individual dimensions. The authors therefore asked whether the investor has detailed instructions on how to deal with each of these individual ESG dimensions. This survey results reveal the 60% of the investors have detailed instructions on governance factors, whereas 43% of the investors have detailed instructions on environmental and social factors. And finally, in terms of how ESG information is involved in portfolio construction, the survey reveals that 55%, 58% of the respondents use red flagging, and less than 20% of the respondents use ESG investing to limit the investment universe, since this is not a main strategy used in portfolio construction. And other popular use of ESG information is to manage the risk, 67%, stock valuation, 50%, and stock monitoring, 44%. The author also analyzed the differences between portfolio managers originating from different domiciles. From the survey result, we can observe that there is a remarkable difference in the perceptions of US and European domiciled portfolio managers. Portfolio managers living in the United States on average do not share the strong belief in the existence of positive relation between SRI and performance by European and UK investors. However, more than with European and UK investors, they expected a positive impact on long-term performance risk reduction. And another remarkable observation is that most UK, US, and UK domiciled managers attach a low weight to environmental and social factors, while US managers follow their European counterparts in attaching a high weight with respect to governance factors. So due to the time constraints, we have covered only important results of this research paper. I suggest that you read through the paper, analyze tables, and compare your thoughts with the author's descriptions. And in this way, you can both deepen your understanding of the paper and train your ability in paper analysis. So this is the end of this chapter. Thank you so much for your attention, and see you next time.